The collapse of Phones4U has shocked customers in the mobile phone retailer and its employees, 2,400 of whom will lose their job. But it's also a blow for the company's bondholders, including some pension funds. These investors lent over £700 million to Phones4U and will be lucky to get much of it back. Did they underestimate the risks of the company? And more importantly, do investors underplay the dangers of bonds? It's an important question because bonds have a reputation as dull but reliable investments. They're a kind of IOU issued by governments and companies when they borrow money. Investors who buy a bond usually get a fixed rate of interest, known as the coupon, and their money back when the bond matures in 5, 10 or more years. This makes them quite different to shares whose prices can jump up and down and whose dividends can be cut. Bonds are often used in investment portfolios to smooth out returns, but to say they're safer than shares is a dangerous generalisation. There's a huge universe of bonds with different levels of risk. Creditworthy borrowers pay less interest on their bonds than risky creditors, who pay more because they may not maintain the coupon or return the capital. Here you see how the average coupons on government bonds vary between the UK, US and Italy. Coupons on corporate bonds are higher because companies are riskier borrowers. Unlike governments, they can't raise taxes or print money when they're short of cash. Companies with good credit ratings on average pay 6% in the UK. Higher risk companies like Phones4U pay up to 10%. This gap between the interest on government and corporate bonds is known as the spread. For example, if the interest paid by new government bonds rises by 1%, you might see the coupons on new corporate bonds rise by the same amount. The spread between them remains the same though. But the coupon is just half the story. The coupon is the interest rate that you get if you buy a bond at launch and hold it until maturity. That's unusual because bonds are traded all the time between investors. This affects the yield or income that investors get from the fixed coupon. For example, if there are lots of buyers of gilts, their price rises. If investors pay more than the original price of the bond, their yield will be less than the coupon. Of course, if gilts are unpopular, their price falls and the yield rises. The yield on government bonds is an important economic indicator. It shows where investors think interest rates will be in the future. After the financial crisis, the Bank of England wanted to keep long-term interest rates low. It bought a staggering £375 billion of gilts to drive up their prices and force down yields. This means gilts are expensive and yield about 2%, which is a lot less than their coupons. Corporate bond yields have also fallen because they're linked by the spread to government bonds. As yields have fallen, investors have looked to riskier, high-yield bonds like Phones4U for a better return. Phones4U had two bonds. The first were senior bonds, which means they stand at the front of the queue of creditors hoping to get some money out of the company's administrator. The bonds were issued in 2011 and raised £500 million with a coupon of 9.5%. Crucially, they were secured on assets in Phones4U's main operating company. The second bonds were issued last year to raise £205 million to pay a dividend to the venture capitalists who owned the business. These bonds were subordinated, which means they're at the back of the queue of creditors. Moreover, they were payment-in-kind bonds. That means they didn't have to pay coupons but could repay all the interest in one go when the bond matured. And they were only secured on a holding company which had very little assets. Compared to the senior bonds, the subordinated bonds looked unattractive, yet they offered a coupon of 10%, just a fraction higher. It appears that investors who looked at the double-digit rate of interest may have ignored the risk of lending to a company whose main suppliers were about to walk away. As things stand, the first group of bondholders are going to suffer a nasty haircut. That's jargon for losing a lot of money. The payment-in-kind bondholders will lose all their money, however. Phones4U is an extreme case. The number of companies going bust and defaulting on their bonds like this is low. Nevertheless, it shows that investors need to take care when buying bonds and not just go for the highest coupon they can find.